This is supply, this is demand, and this is the exact spot where a bank just parked more money than your entire city will earn this year. By the end of this video, you'll be able to find these spots on any chart on any time frame. You'll know why they work, when they fail, and how to trade them with entries so precise they feel unfair. One promise before we start: never trust anyone on YouTube, including me, without testing things yourself. That's why later in this video, I will also tell you how to backtest everything you are about to learn. Let's get straight to it. First thing first, open TradingView. If you don't have it yet, I leave a link in my description. Now let me ask you something that sounds stupid. Why does a chart go up? No, seriously. Most traders have never spent 10 seconds on this question. A chart can only go up for one reason. There is more buying pressure than selling pressure. It can only go down for one reason. More selling pressure than buying pressure. That's it. When buyers and sellers are roughly balanced, price drifts sideways or grinds slowly. Boring. But when price has a drastic majority, price doesn't drift. It explodes. A sharp, violent move in one direction is the market screaming at you, at this exact price, one side completely crushed the other. Slow drift means a small edge. We don't care about small edges. We care about the places where the imbalance was brutal. Remember this word: sharp. If the move isn't sharp, we're not interested. Now here's a mental switch that will change how you see every trade for the rest of your life. Every time you buy, somebody on the planet is selling to you at that exact price. Every time you sell, someone is buying from you. There is always someone on the other side of your trade who thinks you're wrong. So the real question is never, should I buy here? The real question is, who am I buying from? Would you rather buy from a consistently profitable trader who knows exactly what he's doing, or from a guy who FOMO'd in 5 minutes ago and is now panic selling to you at a discount? So the game is simple to describe. Buy where the big players bought, sell where the crowd is overpaying. The only question is how to see where the big players did their buying. And to answer that, we need to look inside the engine of the market. Every market runs on an order book. On one side, you have all the buy orders waiting at each price. On the other side, all the sell orders. There are two kinds of players in this book: passive players and aggressive players. Passive players place limit orders and wait for price to come to them. Aggressive players smash the market button and take whatever price is available right now. So imagine a big institution needs to buy 10,000 lots at market. Aggressive order. But at the current price, there are only about 100 lots available for sale. What happens? Their order eats those 100 lots instantly, then eats everything at the next price, then the next, then the next, climbing the book like a hungry Pac-Man until all 10,000 lots are filled way higher. That is what a sharp move is. It's not magic. It's not news. It's a giant order consuming every available seller on its way up. And here's the beautiful part for us. Institutions cannot hide this. A whale can wear a disguise, but it still leaves a whale-sized splash. That splash, that violent candle on your chart, is a footprint. And footprints tell you exactly where the whale was standing when it jumped. One more detail. Institutions almost never get their full position filled in one go. There simply isn't enough liquidity. So when price comes back to the level where they started buying, they have two huge reasons to defend it: to fill the rest of their order at the same nice price, and to protect the profit on the position they already have. That's why zones get respected. Not superstition, unfinished business. So now you know why zones exist. Next question is, what do these zones actually look like on your chart? Markets breathe in a simple rhythm. Balance, then imbalance, then balance again, forever. Balance is the boring sideways chop where buyers and sellers agree. Imbalance is the explosion where they violently disagree. A zone is always born in the same place, the last patch of balance right before an explosion. And there are exactly 4 versions of this story. 1. Rally, base, drop. Price goes up, pauses, then collapses. The pause is a supply zone, and it's a reversal zone. Sellers ambush the buyers at the top. 2. Drop, base, drop. Price falls, pauses, falls again. The pause is a supply zone, continuation type. Sellers just stopped for a coffee and kept going. 3. Drop, base, rally. Price falls, pauses, then rockets up. The pause is a demand zone, reversal type. Buyers caught the falling knife on purpose with gloves. 4. Rally, base, rally. Price rises, pauses, rises again. The pause is a demand zone, continuation type. Don't stress about memorizing the names. What matters is the pattern. The base is where the orders were loaded. The explosive move is the proof that someone big was loading. No explosion, no proof, no zone. Time to get your hands dirty. This is the part 90% of people get wrong, and it's why their zones look like abstract art. The rule is one sentence. Mark the last candle before the impulse. Not the last red candle before an up move, not the last green candle before a down move. Forget candle colors. You want the last candle of the base, the final moment of hesitation before the rocket launched, whatever color it is. Why? Because that candle is where all the pressure finished accumulating. It's the loaded spring. The impulse is just the spring releasing. How do you recognize it? It's usually an indecision candle, small body, big wicks on both sides. Wicks are rejected prices, so big wicks with a tiny body means the market tried to go up, tried to go down, and failed at both. A candle having a full existential crisis. That crisis is your zone. Now draw the box. From the high of that candle to the low of that candle, wicks included. Then extend it to the right. One small refinement: if the very next candle poked a slightly higher wick or a slightly lower one, before the impulse really launched, extend your box edge to cover that wick too. You want the whole footprint, not half of it. That's it. That's the whole drawing technique. But the hard part was never the drawing. The hard part is knowing which rectangles deserve your money. These are the 5 filters in order of importance. First filter: a demand zone in a downtrend is not a buying opportunity. At best, it slows the fall for 1 or 2 candles. Then price breaks through it and keeps dropping. So before you touch any zone, zoom out and look at the structure of the market. Do you see higher highs and higher lows? That is an uptrend. You only buy demand zones, and every supply zone on your chart stops existing for you. Do you see lower lows and lower highs? That is a downtrend. You only sell supply zones. You can confirm the trend with breaks of structure. In a healthy uptrend, every swing high gets broken by the next push up. But if you want extra help, put an EMA on your chart. Price clearly above the line, you only look for longs. Price crossing the line up and down with no direction, you don't trade at all. This single filter removes more losing trades than any other rule in this video. Filter number 2, the imbalance. When a real institutional move starts, it leaves a gap behind it, an open price area that later candles never traded back through, where the wicks don't touch each other. That gap is called an imbalance, and it works like the exhaust flame of a rocket. It proves the launch was real. The rule: a zone is only worth trading if there was still an unfilled imbalance connected to it. If price already came back, filled that gap, and traded through the whole area, the fuel is gone. The orders are gone. The zone can still look nice, but it's an empty box. Check for the gap first. No imbalance, no trade. Filter number 3, freshness. A zone is like a warehouse full of waiting orders. The first time price comes back, those orders activate, and that is the reaction we trade. But every visit uses up part of those orders. By the second or third visit, most of them are already gone. So the rule is simple and strict. Only trade a zone on its first retest. A zone that has been touched 3 or 4 times is not being respected. It is being emptied piece by piece, and the next visit usually breaks straight through it. Fresh zone, full warehouse, strong reaction. Used zone, empty warehouse, no trade. Filter number 4, the quality of the momentum. Not all explosive moves are equal, and the strength of the move out of the zone tells you the quality of the zone itself. Compare 2 demand zones. From the first one, price left with 2 huge full-bodied green candles, no hesitation. From the second one, price moved up slowly with many small and weak candles. The first zone was built by someone with very deep pockets and very little patience. The second one was built by small players. The same distance covered by one giant candle is worth more than the same distance covered by 3 tired ones. When in doubt, ask yourself, did price explode out of this zone or did it crawl out? You only want the zones price left in a hurry. Filter number 5, the last one, depth and time. This is your early warning system for zones that are about to fail. Depth first. When price comes back, a healthy zone reacts early, usually in the first half of the box. The deeper price goes into the zone, the weaker the buyers or sellers defending it. Past the halfway point, warning sign. Close to the far edge, the zone is probably finished. Then time. A real reaction is fast. Price touches the zone and bounces away within a few candles or a couple of sessions. If price enters the zone and just stays there, moving sideways inside it for days, it means nobody came to defend it. Don't wait for the final confirmation of failure. When price goes deep into the zone and stays there for a long time, close the trade early and accept a small loss. Zones that work don't make you wait, and they don't make you sweat. The 5 filters tell you which zones deserve your money. Now let's talk about when to press the button, because even a perfect zone can be traded badly. Before the entry itself, watch how price comes back to your zone, because the way it returns tells you the truth. You want price to come back slowly, with small corrective candles and no real strength. That is just profit-taking and weak hands, exactly what the zone was built to absorb. What you do not want is price rushing back into your zone with big aggressive candles. That is not a pullback, that is an attack, and a zone that gets attacked with that much force usually breaks. Slow return, green light. Violent return, stay out. This one detail alone upgrades the whole strategy. And when the return looks right, here is the exact entry sequence. Price reaches the zone, heart rate goes up. No improvisation, just 3 mechanical steps. Step 1, the tap. Price must actually touch the zone. A wick into it or a close inside it, both are fine. But if a candle closes clearly beyond the far edge of the zone, body and all, the zone is invalidated. No trade, no discussion. Step 2, the hold. Watch the first candles inside the zone. You want to see rejection, wicks entering and getting pushed back out. Small bodies, one side clearly failing to make progress. That is the defense arriving. Step 3, the confirmation. Wait for a strong candle in your direction, a proper engulfing or momentum candle that closes back outside the zone. That candle is your entry. Yes, your entry will be slightly worse than the perfect lowest price. In exchange, you avoid a huge number of zones that simply fail. That is cheap insurance. Stop loss. A few ticks beyond the far edge of the zone, past the wicks. If price gets there, the idea was wrong and you want to be out. Target, the next opposite zone. If you buy from demand, your target is the supply zone above. If you sell from supply, your target is the demand zone below. You enter at the edge of a zone with your stop right behind it. That is exactly why this style creates such extreme risk-to-reward numbers. You risk a very small amount to capture the whole range. Theory is done. Now we trade it on the chart. We're on the 15-minute chart. First, structure. Higher highs, higher lows, a clean break above the last swing high. This is an uptrend. So from this moment, supply zones don't exist for us. We are buyers or we are spectators. Now I look left for the origin of the last move up. There it is. 3 big green momentum candles, and right before them, a small indecision candle with wicks on both sides. That's my base. I take the rectangle tool and box it, high to low, wicks included, and extend it to the right. Filter check, out loud. Trend, bullish, pass. Imbalance, there is a clean unfilled gap right above my zone where the wicks never met. Pass. Freshness, price has not been back since the impulse. This is the first touch. Pass. Momentum quality. The exit was 3 full-bodied candles. That is an institutional footprint. Pass. Price is coming back toward us right now, and look at how. Small red candles, overlapping, no aggression, a tired pullback. Exactly what we wanted. Price taps the zone. I don't touch anything yet. First candle wicks below and closes back inside. Rejection. Second candle, a strong green engulfing closing out of the top of the zone. That's the trigger. I'm buying now. Stop goes a few ticks below the zone's low, under the wicks. Target is the fresh supply zone above us, the origin of the last drop. That is the 3.4R trade. And now we let the zone do the work. Price lifts off, pushes into our target area, and there it is. Take profit, hit at the supply zone. We risked the size of one small candle to capture the entire range. That is the whole strategy in a single trade. Different market, same 15-minute time frame. Structure first. Lower lows, lower highs, and the last swing low just broke. Downtrend. Demand zones are now invisible for us. We only hunt supply. Looking for the origin of the last drop. There, a rally. Then a 2-candle base. Then a violent drop. Rally, base, drop. Straight from the textbook. The last candle before the impulse is a small-bodied candle with a long upper wick. I box it high to low, and since the next candle pushed a slightly higher wick before the drop, I extend the top edge to cover it. Full footprint. Filters. Trend, bearish. Pass. Imbalance below the zone. Unfilled. Pass. First retest coming. Pass. Exit momentum. One giant red candle did all the work. Very strong exit. Pass. The pullback toward our zone is slow and heavy. Weak green candles crawling up. Perfect. Price is entering the zone right now. First reaction, a long upper wick. Sellers pushing it straight back down. Next candle, a heavy red engulfing closing back below the zone. That's the confirmation. I'm selling now. Stop a few ticks above the zone's high. Target, the next fresh demand zone below. Notice we are only in the first third of the zone. The defenders showed up immediately. No waiting, no deep entry. And price turns down, breaks the pullback low, and drives straight into our demand target. Take profit. 2 trades, 2 different directions, 1 identical checklist. That's the point. This is a procedure, not an option. So now you can do the whole process by hand. Read the engine, find the base, draw the box, run the 5 filters, time the trigger. Which means you have earned the right to stop doing it manually. Because let's be honest about the cost. Scanning many markets, many time frames, marking zones, checking freshness, redrawing everything every session, that is hours of work. And hours of repetitive clicking is exactly where humans become sloppy and machines don't. Go to the Indicators tab on TradingView and search for MTF Supply and Demand Zones by Flux Charts, or use the link in my description. The moment you add it to the chart, every valid zone gets drawn automatically, and here is the important part. It draws them with the same logic you just learned. The consolidation base, the strong exit move, the zone borders. You will look at its boxes and recognize your own work. That is exactly why I made you learn the manual way first. Now you can check the tool's work instead of blindly following it. Now open the settings. There are 2 options. Momentum mode looks for sharp, dramatic bursts of price and marks the exact spot where the move started, basically the aggressive footprints from earlier in the video. Quick, simple, and perfect if you want the most obvious zones, the ones that jump straight off the chart. Regression mode is the more analytical option. It was built to imitate human judgment. It scans for tight consolidations, then checks for a decisive impulse away from that base, and only draws the zone if that impulse is strong enough. Instead of looking at single candles, it measures the overall structure of price statistically. It filters out noise, stays more stable across time frames, and works better if you prefer a calculated, longer-term structural view. So, if you hunt the obvious explosions, use momentum. If you build bigger picture setups, use regression. One more setting deserves your attention: sensitivity. With the momentum method, this controls how aggressive the indicator is when it searches for zones. Turn it higher and more zones appear, even from smaller moves, so more opportunities. Turn it lower and it filters everything down to only the strongest, most impactful levels. After the 5 filters, you already know which direction to choose. You can also decide how a zone gets invalidated, by a simple wick or by a full candle close, and set the visibility range so distant zones don't clutter your chart. And now the feature that manual drawing can never match, multi-timeframe zones. You can sit on a 5-minute chart and still see the zones from the 15-minute and 1-hour timeframes, all on the same screen, live. Remember why this matters. The higher the time frame, the bigger the warehouse of orders. And that higher time frame context is exactly where most traders fail. They take a clean 5-minute setup and run it straight into a higher time frame supply wall they never saw. With multi-time frame zones on, that wall is never invisible again. The indicator also prints a label every time a zone gets retested and another when it finally breaks. And these are some of the most tradable events on any chart. And to complete the package, you can set alerts for everything. New zones forming, zones getting retested, zones breaking. You get notified in real time, so you can stop staring at charts all day and start responding to real setups. Let's replay our workflow with the tool on. We are on the 15-minute chart, momentum detection, but here's the key. I turn off the 15-minute zones and turn on only the 1-hour and 4-hour ones. Why? Because the higher timeframe zones are where the strongest institutional orders sit, and trading directly off them gives you the highest probability setups. The market is in an uptrend, exactly like our manual long, higher highs, higher lows, so we only look for buys. Price pulls back slowly into a higher timeframe demand zone, the retest label appears, and my checklist is already 80% green before I have drawn a single object. I stack one extra confirmation on top, the same trigger logic from before, and the trade is the same trade we built by hand. The difference is that finding it took 30 seconds instead of 30 minutes. And with alerts active on my other charts, I get notified about every new setup without watching a single one of them. One last thing, never trust anyone, including me, without retesting. The same team built a supply and demand backtester. You define the rules. For example, longs on retests of 1-hour demand zones, shorts on 1-hour supply zones, and it runs the strategy on years of data in seconds. Win rate, profit factor, drawdown, number of trades, the full report instantly. No backtest can guarantee the future, but there is a huge difference between traders who feel that their strategy works and traders who know its numbers. And speaking of backtesting, I put together a free guide that walks you through exactly how to test any strategy you come across on YouTube step by step. And the good news, you do not need to code, and you do not need to pay for anything. Download it from the link in my description. It is absolutely free. All I ask in return is one comment. I want to know why you trade, not the surface answer, the real reason. Freedom, family, proving someone wrong, whatever it is, drop it below. I read every single one and I want to know who I'm talking to. That's all for this video, and I'll see you guys next time.